I've been watching the bond market for a while, and like a lot of people, I've been skeptical of long-term US treasuries. They've had a brutal run, but recently my thinking started to change, and I realized this might be the right moment to start building a position in the iShares. Let me walk through my reasoning. First, let's be clear about what TLT actually is. It's an ETF that holds US government bonds with maturities of 20 years or more, making it a pure play on long-term interest rate. Because of this long duration, roughly 16 years, it's one of the most rate-sensitive ETFs on the market. If long-term rates fall by 1%, TLT would theoretically rise by about 16%. That's the upside. But there's also downside. Because of that long duration, if rates move against you, the loss can be painful. I'm comfortable with that risk because the odds are starting to stack in my favor. Here's the first reason I decided to buy. Yields are already at extreme levels. The 30-year Treasury yield recently touched about 5.2%, the highest since July 2007. At the same time, the 20-year yield has been hovering between 4.6% and 4.8%. From a historical perspective, these yields are unusually high. If you buy TLT at these levels, you're locking in a starting yield of around 4.5% to 4.6%. But yield alone isn't enough. What matters is where yields are headed next, and that brings me to the Federal Reserve. The Fed has already cut its policy rate by 0.75% over the past year, bringing the upper bound down to 3.75%. Futures markets are expecting more cuts ahead, potentially 3 more by the end of 2026. Historically, a falling Fed funds rate tends to pull long-term yields down with it, though not always in lockstep. When that happens, TLT price mechanically goes up. That's the core of my bet. But there's a second, more defensive reason for buying TLT. Safety. Long-term US Treasuries have been the world's ultimate safe haven. In an uncertain world, that matters more than ever. Geopolitical tensions, trade conflicts, and global unrest all tend to push investors towards the safety of US government debt. And TLT's massive size, currently about $43 billion in net assets, make it incredibly liquid, with daily trading volume averaging around 27 million shares. In fact, major institutional investors like pensions fund have been quietly building large positions in TLT, not as a short term, but as a long-term structure allocation. When the smart money moves in size, I pay attention. And here's a final reason, one that I find particularly compelling. The short position on long-term treasury has become one of the most crowded trades in the market. At some point, the dynamic can reverse violently. As one analyst put in, the extremely crowded short position in long-dated US bond has set the stage for a powerful asymmetric trade, limited downside for current levels but explosive upside if yields start to fall. That's the punchline. When everyone is already betting against something, even a small catalyst, a weak job report, a dovish Fed comment, an escalation in geopolitical tensions can trigger a sharp squeeze that pushes price much higher than anyone expects. Look, I'm not pretending TLT is risk-free. Far from it. If inflation stays sticky or the Fed stay hawkish, long-term yields could keep rising and TLT could keep falling. The fund has already lost nearly 50% from its 2020 peak. And with duration at nearly 17 years, every 1% rise in yield could knock TLT down by another 17% to 19%. That's real risk. But I'm not betting on a single scenario. I'm buying TLT for two reasons. First, as a tactical bet on falling interest rates in the cutting cycle that has already begun. Second, as a strategic ballast, a safe haven asset that tends to zig when stocks zag. In a portfolio that diversification is valuable. So, after months of watching and waiting, I decided to take the plunge. Yields are at 19-year highs, the Fed is cutting, the shorts are crowded, and the institutions are buying. For me, the case for TLT has never been clearer.